Hi, this is Hille and welcome to Trade Mentoring Session via video. Okay, I want to talk in this video about the Nikkei Index. Now this is a chart I sent to some of my trading friends. I didn't send it to my trade mentoring group on the 1st of February, but I sent it to a group of my trading friends on the 1st of February and asked what they thought about it. So I noticed way back in the 1st of February what you can see here, and this is a chart obviously going right back to 1985. So this is a chart I've got on the internet because my trading platform does not go back this far. And as you can see in this chart, just around here, price has broken up out of this range and in fact has broken above that peak there, therefore obviously of course all of these peaks. So for one, I'm interested because I like breakouts, and for two, I can go back and I can see what happened at the similar level here, and we raced up an incredible 3.5 times, and even more recently from a similar level which is down in here, and price went up from just over 10,000 up to about 17,000 before it came down again, and then went back up to a high of around 18,000. So I was interested in that chart right back on the 1st of February. Let me show you the current price chart for the Nikkei Index, and here it is. First thing I want you to look at is how we had right here a breakout from a previous period of 1, 2, 3, 4, 5, 6, basically 7 months in consolidation. So we broke down below this level. We have made very similar or almost exact highs here. Clearly that's a level that once it breaks you can take a breakout trade, and also you can see right here after we've made the breakout there's this candle coming down which touches the level again before bouncing off again. Now unfortunately I wasn't thinking about this market at all back in November last year, so I did not take this breakout. Had I been aware of it, I could have and should have taken this breakout here because it's a very low risk long, and then even if I'd missed the breakout I had a chance 6 days later to take it as it came down and bounced off support and resistance. And now of course we can see that it has gone up much as I expected it to when I looked at that chart I've just shown you, the long-term chart on the 1st of February, and thought that there's a very good chance this thing could go up thousands of points. Okay, so what do you do therefore if you're like me and you've missed the breakout but you notice a trend has formed? Well, obviously the thing you need to do is join the trend, or find a way to safely join the trend. So as I've said before, there are only two types of trend trades. There's the breakout and there is joining an existing trend. So I did join this existing trend, but I didn't do it very successfully, unfortunately. And there's a couple of reasons for that. The main one is this fall here between this high here and this low here, which doesn't look all that much in the scale of things, but that is actually 804 points, or 804 yen if you're looking at 1 yen per point of the index. And if you take one Nikkei futures contract, it's 500 yen per point. So you're obviously looking at a lot of points and a lot of money if you have one large yen contract. Of course you can go smaller than one full futures contract, and I have done that since and previous, but at that time what I was doing is being very aggressive, loading up on big positions with tight stops, and of course I got stopped out in here. And here is another 600 point fall, which I don't think I had any positions in here, but essentially I have missed out on a lot of money on this trade because I was too aggressive and not allowing myself wide enough stops. However, I have now found a method that will allow me safe entry into this trade, because as I said when I looked at this original trade, and as I said at the time, and I still think that this could get to 18,000 this year. Now this was on the 1st of February up here. I'll show you the latest one that I've taken, which I did on the May the 2nd, and you can see exactly the same thing, except they've raced up now to above 14,000. So we're well on our way. It's been a massive move. I mean, 40% in a few months is a colossal move in any stock market. We've seen that already. My expectation is it's going to go higher. As always, when there's a strong trend, the probability is the trend is going to continue rather than not continue. Okay, so how have I found a way to trade this? Okay, you know from previous emails that I particularly like to find 2 moving averages. Sometimes I use 4, but generally it boils down to 2. And when you're using moving averages, you can play with the moving averages themselves, and you can play with the time frame to find one that fits well. What fits particularly well, and you can see this is exactly the same chart as before. Here's our breakout. Doesn't go back as far as the previous one, and here we have all of the trending since. Now I am using a 10-day and a 30-day simple moving average just overlaid on the chart, and we're not concerned with the breakout now because you use the moving averages to determine when you should join a trend, and you can see there are lots of opportunities to join this trend as price comes back into the moving average. Here's one, here's another, here's another, here's another, another one, another one, another one. There's a touch there. You could say there's a touch, certainly a touch there. This one here, it is an entry, but I'll talk about that in a second. There's another one here, and there's another one here, and in fact the latest position I have taken was long here as it came down and broke into this moving average. Okay, so briefly, how do you take this trade? First thing is you wait patiently. So you do not take a trade right now when it's above the moving average. You wait patiently for it to come down and at least touch or ideally break below the 10-day moving average. When you do that, then you wait for another candle to form, which is a bullish candle. So for example, given this candle here, you see that it's broken down below into the 10 and 20 moving average. You wait until the next candle breaks above the previous candle to go long. Now if you want to be slightly more aggressive, you can go down to a 4 or an 8 hour time frame, and you can wait until a previous 4-hour candle has formed, and then there's a break above that. Now the reason you want to wait for a break above the candle is you don't want to be in a situation, because of course at this point here you don't know what's going to happen, and this price could just fall down and go down to 10,000. So you don't want to be buying in a falling market. You want to wait for there to be a small candle, in this case the daily candle, but as I said, you can go down to 4-hour or 8-hour. Wait for a small candle to form in this moving average buy zone, and then the next candle breaks above it. You take a long trade 1 pip above the high of the previous candle, and you can put your stop 1 pip below if you want to take a relatively aggressive entry, because obviously it's a very tight stop. Or if you take a smaller position, you could actually put your stop right down here where the 30 period moving average is. Now down here, this wouldn't, well, you could have definitely taken this, because have a look at this daily candle. It's a down candle, there's no break above it. This next candle, also a down candle, there's no break above it. So you wouldn't have got long even if you'd put a trade to go long above the high of that candle. Let's come down to this candle here, however. Okay, it breaks down below the 30 period moving average, but we're putting our stop above the high. Let's see if I can stretch that out so I can show you exactly what I'm talking about. Okay, so here is our candle here. Even if we put an order in to go long at the high of this candle here, we wouldn't get set. So once the second candle starts forming and it goes below, then that invalidates any previous order we put on to go along at the break up of that candle. So then we'd cancel that order and we'd start looking at this candle. Once this candle had formed, we'd go, okay, we'll go long if it breaks the high of this candle, and sure enough the next candle breaks long, and then we can have our stop down below that candle. So it's actually a very short stop. So the high of this candle, as you can see down here, I'll have to go back up here, but if you keep your eye on here, you'll see that the high of that candle is 12,195. So these go in fives. So you put your order in at 12,200 with your stop below the low. You can see the low there is 11,815. So therefore you put your stop at 11,810, and that is a, you know, what is that, 85 plus 95, 180 points. Not a huge amount. And then you get long and you're away. And that's exactly what I did in this candle here. Got long and we're away. And we're expecting at some stage that price will come back into this moving average buy zone. Now if price comes into this moving average buy zone like it did here, and then continues to fall, say right down into this period, you know, let's lift this line up here. So let's say it falls right down into this zone here, then it's invalidated the pattern that I've noticed. And as technical traders, we are always looking for patterns. Now if it invalidates this pattern and breaks down out of this 10 and 30 moving average buy zone and comes down into here, then this whole pattern is invalidated. And if I want to get long, I've got to look for another reason to get long, and I'm probably not nearly so keen to get long, because part of the reason I want to get long is that we've got this lovely pattern that keeps recurring over and over again, which is giving me trading opportunities. So I am long. I've based on what's happened in the past, I think we could go to 18,000, but who knows? Predicting the future is a very difficult thing to do, and I never try and do that. What I simply say is that price is going up. I'm a trend trader, therefore I need to be part of this trend. I'm going to continue to be long until this pattern breaks down, and when this pattern breaks down, then I'll have to reevaluate everything else that's going on. So you're welcome to use this pattern. As always, I don't recommend you trade what I trade. I don't recommend you trade it in the same way that I trade it. And the reason for that is simple, that I might wake up at 3 o'clock tomorrow morning and see something on this chart that I don't like, that invalidates what I think, or there may be a piece of news comes out or whatever, and I get out of my trade. And if you have taken the trade, because I have, and I don't tell you I'm out, then the whole reason you took the trade, if you just took it because I took it, is you know, going to leave you in a troubling position if I'm no longer in it. But the point of this video is, when you see a trend trade, try and find a pattern, and a dual moving average like this is a very good way to define a pattern. If you can find a pattern that gives you trading opportunity after trading opportunity, then take it, because probability is in your favor for a successful trade. Happy trading. Talk soon.